Okay, at this point, we get to a special treat. We're joined by Alex Manzara, my favorite Eurodollar option trader, or actually broker, the fellow that I always turn to whenever I have questions about what's going on with the Eurodollar market. Thanks for joining us today, Alex.
Well, thank you guys for having me. It's a pleasure to be here.
Yeah. So we start with this picture of you. This is you. I guess that's not yesterday, Alex. That's a few years back.
No, this picture is from the before the turn of the century, as a matter of fact, in the late 1990s. And this was when I was a broker for Commerce Bank at the Chicago Mercantile Exchange, and that is right in front of the Eurodollar pit.
Yeah, so you're an old school kind of Chicago trader, and you watch, and I love your insights that you give in your blog, Chart Point. And I was just wondering what's on your mind. Like, what do you got prepared for us today?
So the thing that I wanted to start with is the first picture here is I was thinking a lot about when Trump was saying that um, the U.S. might match the manipulation of China and of Europe. And so this first chart, and in terms of FX manipulation, and so this first chart is shows in the amber the dollar yen, which from 2012 to 2015 went from 80 to 125. It should have been a huge boost for Japan, right? And if you
Right.
can see the upper, the amber arrow shows the depreciation. The white line shows the inflation rate in Japan. And so at first, the yen depreciation worked. It inflated Japan, but the green line is the GDP. And that never really got above 1%. So this idea that depreciation is going to solve the problems of central banks in terms of trying to get inflation higher doesn't really seem to work. If you go to the next slide, I'll just kind of quickly go over this. The central banks have sort of been on the same topic for a long time. This is from a talk that Kuroda gave in 2013 to the Kansas City Fed, and you can see that he was talking about a high natural rate and saying that we're trying to get inflation up, and of course, it didn't really work. And this is from 2013, and so it's been the same central bank song and dance for a long time. On the next slide, if you can advance. So on the next slide, we have Brainerd from September of last year, who sort of said the same types of things, talking about the natural rate. But what was interesting here is that she said as the Fed was raising rates, the natural rate actually, or the neutral rate actually went up as well. So this was something that indicated really that maybe the Trump stimulus of late 2017 and early 2018 was working. And of course, the Fed was also tightening at this time. So this was, but again, it's been the same topic out of the central banks for a long time. And if you can just advance then once more. So that's essentially it in terms of the central banks. But this is the recent history right here, and this I just want to talk about sort of how the futures markets depict what the sense of odds are for Fed easing or for Fed tightening, etc. This specific picture that we're looking at here is the July to August Fed fund spread. You can see that in late May to early June, as this spread declined, it indicates that the August contract was much higher than the May contract. So this spread went all the way from around 0 or around -5 basis points all the way down to -34. So -34, what does that mean? It means at that point, and there's a FOMC meeting at the end of July. So are our guests familiar with how the Fed funds contracts work, do you think?
Well, why don't you tell? Why don't you just kind of go over it so everybody is like I think
Okay.
Patrick and I know, but not everybody is. So why don't you just walk us through it?
Okay, so the Fed fund contracts is the average of the Fed effective rate of the Fed funds over the contract month. So in this case, it's a very easy spread because there's an FOMC meeting right at the end of July, on July 31. So whatever the Fed does at that meeting will completely affect the August contract. In other words, if the Fed were to ease by 25 basis points, then the August contract would theoretically be 25 basis points higher in price than the July contract.
Right. And I think that everyone should kind of understand the difference on the Fed funds versus the euro dollars. The euro dollar is the settlement into the 3-month LIBOR
3-month
rate at that
LIBOR.
time. And
Right.
it doesn't average over any period. It's an actual, like, it's the setting on that day. So that is kind of it's a big difference, right, between those two contracts?
Well, it's a very big difference, and if you're looking specifically at what is priced in to the market for the Fed specifically, the Fed funds are a much cleaner way to do it because there's a spread between Fed funds that the Fed really that's the rate that they control to um, LIBOR. Sometimes
Right.
the
The
LIBOR
credit,
OIS, it's kind of a credit
that's
spread, right? So
that's
that
correct.
spread can widen or narrow, right?
That's right. And the other thing that you mentioned is that you said something about the effect of the effective Fed funds, which is different than the target. And why don't you explain to people how, like, even though the target might be, 2.25, the effective might run 2.12 or something, and how it might be a little bit different.
Well, the Fed effective rate is I think it's a weighted average of the actual amount of Fed funds traded between banks. Um, and that rate is computed daily and it comes out the very next day. The Fed fund target currently is a quarter basis point wide between 2.25% and 2.5%. But the interest on excess reserves, IEOR, is 2.40. So we essentially figure that the Fed effective rate is going to be right around IEOR, in other words, 2.40%. In the last couple of days, it's been a little bit higher. That indicates to some extent that there's a little bit of a funding, maybe a little bit of a funding crunch. This is why the Fed a couple of times has tweaked this interest on excess reserves at the meeting in order to try to keep the Fed funds rate within target.
Right. But when people go look at the Fed funds futures, they should just be aware that is based upon the effective and not
On
the
the
target.
average of the effective, right, and not
That's
on the
correct.
target specifically.
That's right. Yeah.
Right. The previous chart shows that the market at one point was showing at negative 34.5. There were fears that the Fed might ease 50. And now it's come back to around 25 basis points, 28 basis points. So the market now is pretty convinced that there's going to be 25 basis point ease, and that's that. Now, if you move to the next chart, because this does show Eurodollar 1-year calendar spreads in the next couple of slides, and these are longer term charts, you know that the last easing cycle was from the middle of 2004 to the middle of 2006. This lower panel of the chart, and this is the first Eurodollar contract to the fifth Eurodollar contract. So that's a 1-year calendar spread. The lower panel of the chart shows the spread. So in the green parts of this chart, the spread is positive. In other words, the nearer contract is at a lower rate than the farther contract. That would be a positive yield curve. You can see that as the Fed is starting to, this was a tightening episode. As the Fed starts to tighten in the middle of 2006, the spread goes negative. It goes red. And and that indicates that the Fed is tight. So this spread, the first to the fifth contract, got as low as negative 158 basis points. In a very rough way, you can sort of say, well, the market was expecting, a total of 3 ease, or a total of 150 basis points of ease within a year at the very low of this spread. So
Right.
so these spreads give a very rough indication of timing and magnitude of what the market feels like the central bank might have to ease. When these spreads invert, when they go negative, and there's been a lot of talk about the Treasury curve longer term going negative, but these short-term Eurodollar spreads also give a lot of indication of what the market's perception is in terms of the central bank being easy or tight. And when it goes red, kind of indicates that the Fed is tight, or the central bank is tight, and that they're going to have to ease. So the current SEP spread, which is currently the first to the fifth contract, is around negative 41 basis points. That would indicate that the market thinks, well, there's 1 or 2 eases between September of this coming year and September of next year. Of course, we've already determined that we think there's going to be a 25 basis point cut already at the end of July. So go ahead. Did you want to insert something else?
No. Sorry, no. You keep going.
No, not
Sorry
at all.
Interrupt.
So what I've done then I've also just included the second to the sixth contract on a rolling basis, and then the third to the seventh. And what you can see is that as you get further out the curve, the spreads are less and less negative. In other words, the market kind of thinks the easing is going to be front loaded. It's going to happen and then it's going to stop. And of course, when you've got rates as low as they are, 2.25 to 2.4%, wherever, it makes a lot of sense, right? You're going to get down to the zero effective bound anyway. So that's just sort of an indication there. You'll note that in this cycle, all the Eurodollar spreads, or the first 3 one-year calendars, went negative at the end of the year when stocks were getting slammed, and they never really came back to positive since then. Even though we had even though the Fed changed, even though we had a big rally in the stocks, these spreads remained negative. So it was always an indication that the Fed is tight, the Fed's going to have to ease.
So Alex, can I interrupt there for you? It's Kevin.
Sure.
So I had a question for you. It felt to me like that the market bullied the Fed into this kind of, I don't know if I want to use the word desire, or almost forced the Fed to go and price in a lot of easing. And when I look at these charts, it actually very quickly becomes clear to me that it actually wasn't that dramatic. And if we go back to your first chart, we can see from the 1 to 5 kind of spread that it was actually it was actually much more. They bullied the market, the Fed, a lot more in 2007 than they are currently.
Well, sure, that's the case, but think of where rates were in 2007. We are, by the end of the tightening cycle in the middle of 2006, we were at 5.25%. So there's a lot more
room. I got it.
Exactly.
So do you feel like, to me, were you surprised at this last market reaction at how quickly they priced in the number of eases that they did? Like it felt to me like that the market quickly determined that a recession was imminent, and that the Fed had kind of fallen behind, and that they had to do a lot of easing. And I was shocked at how quickly the market priced in a lot of cuts without actual confirmation in the data. You trade this all the time. You've been through probably more. You've sat and stared at the Eurodollar futures a lot more than me. Do you feel like that was normal for this market, or do you feel that it was unusual?
No, I feel that it was completely abnormal given that we have full employment, given that we have stocks near all-time highs. And not only that, we had a lot of Fed officials saying, "Hey, look, the economy is pretty good." In fact, I will tell you that, and I don't have anything reflecting this in the slides, but if you the euro-dollar skew became extreme, a bid for calls out of the money, equidistant out of the money calls versus puts. The calls were extraordinarily well bid compared to the puts.
Right.
And what was the reason for that? The reason was, well, look, we've got China problems, we've got global trade problems, we've got Brexit, etc. So the calls were, and on the downside for the puts, market's saying, look, there's no way the Fed's going to tighten. What I will say though is that blew up a lot of blew out several Eurodollar option groups because that's essentially what they trade. And so this move was actually quite extraordinary. It's come back to where it's more reasonable, but I will say that it was definitely an abnormal move, and it blew a few people out.
So,
I'll just
so it wasn't just me thinking that this is that the bond bulls had gotten way ahead of themselves. You're saying that, like, compared to what the fundamentals were showing, these were kind of abnormal moves for the euro dollars in terms of the amount of easings that had been priced in. Now, do you think it was guys getting caught short gamma and that they were the ones pushing it, or do you feel like it was something else? Like, do you think it's a kind of the maybe the new environment we're in with too many hedge funds chasing the limited alpha, and then it just kind of feeds upon itself?
I think more the former than the latter, but I think it's a combination of those things. Sort of a sea change in the perception of what may occur in the future. And there were certainly a couple of large hedge funds that definitely pushed the position and pushed it with a very big size in terms of
Yeah.
Eurodollar call spreads, calls versus puts.
Because I was shocked I saw guys getting on financial TV. And I'm not just talking CNBC. I'm talking about like more sophisticated venues, and
Yeah.
talking about how they were going to get 3, 4, cuts in the next year, and that they could see zero by next year. Like like just like batshit crazy stuff, like end of the world kind of things. Dogs and cats living together. Like,
Right,
that's what
I
I
got it.
saw. And it just seems to me that they kind of lathered everyone up into thinking that this was going to happen. And I was just like, whoa, 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 let's wait. Like, I'm not saying it can't happen, but you're now pricing in almost that surety. And I was shocked at how quickly it went. And I'm glad to hear that you also think that this was an abnormal move.
Well, and it was accentuated by people having to cover bad positions. There's no question about it. I'll give you a small example. In the very beginning of June, for example, you take the December 9 contract. On the 3rd of June, it settled at 98.04. The 98.50 calls, so 46 out of the money, settled at 7.5. The 97.50 puts, which are 54 out of the money, settled at 3.5. So
Yeah.
nearly equidistant. The calls, 98.50 calls, so that's a 1.5% strike, settled at 7.5%, and the 2.5 strike, when the Fed has not even eased yet, only 3.5 basis points. That was a fair amount of skew. Now, if you look at it, from a couple of days ago, from July 10th, the contract settled at 98.01.5. The 98.50 call settled at 3.25, and the 97.50 put at 3/4. So instead of the call being 4 over, and yes, there's a little bit of delta there, but instead of being 4 over, it's now only 2.5 over. Still, there's a bias to the upside, but it lessened after a lot of people blew out. And you can also see it, and it makes sense in terms of the way some of these one-year calendars traded. So, for example, I think SEP, or the first to fifth contract, I think I mentioned, got down to something like negative 58, and now it's negative 40. So
Right.
they took out a little bit of the easing expectation as well over the forward period.
So I have a question for you, Alex, in terms of the skew. Now,
Yeah.
if you think about the stock market, like the stock market obviously gaps to the downside, so therefore it makes sense that it trades with like a crooked smile, with the out of the money puts trading higher because the volatility to the downside is higher. Now, you might argue on euro dollars it's the same in that, or the opposite in that if the shit really hits the fan, we're going to get a situation where the Fed's going to cut. So therefore, the big surprises are to the upside. But you have to remember back to your point about eurodollar being also a credit instrument. And if we go back to 2008, you had a situation where you had LIBOR actually going the opposite way of the Fed funds
Exactly.
rate because
Sure.
right. So I have a question for you. Over time, what does the skew usually look like in the euro dollar market? Is there a skew to the upside? Is that natural and it just was unusual and then it got so extreme? Or is it actually usually more of just a regular smile?
No, it's more of a regular smile, and in the old days, it was more towards puts for exactly the things that you were saying. There's a credit
Ah,
aspect, and it was not. This has been an odd period of history where the rates have been so extraordinarily low, and you would think. As the Fed started to tighten the onset of 2015, even though the hikes weren't particularly aggressive, you would have thought that the bid would go to the puts, would you not? That it was more likely that the Fed would continue to hike, especially when you listen to the various Fed officials saying, "Hey, we've got full employment. We expect things to be better. We expect inflation to go up." The market,
right.
though, never really believed it.
Yeah.
So
It's just a fascinating time. So, Alex, before I see on your charts that you have a 530. You're talking about Treasury, yield curves. That's always one that's near and dear to my heart. Why don't you tell us what you're thinking on that? The 5-year Treasury
Okay,
yield
well,
spread.
I listened to one of your previous messages or podcasts, and you were talking about how you trade the 5s to 30s and how you need to worry about the DV01 on the contract, and you need to do a ratio in order to replicate this spread, and that's true in the futures markets, of course. Um, what I did here is I showed the 530, also the twos tens, and then also in the Eurodollars, the red pack to the gold pack. The red pack is the second year forward, and the gold pack is the 5th year forward.
Okay,
So,
so why don't you explain 1 second? I'm sorry to interrupt, Alex.
sure.
Why don't you explain to people that when they talk about packs and different
Oh,
colors, what they mean?
yeah.
Because I know
So the
even me, like I'm like sometimes you guys take for granted that everyone knows
right,
red,
of
gold,
course.
what
I'm
that
sorry.
means, but no problem. It's all right. So just why don't you give us a little bit of a lesson in terms of what the different colors mean and how they work and what you're talking about when you say that?
So the first four contracts are known as the whites or the fronts, and they are, if you just take the average of the first four contracts, you trade them as a pack, four contracts at a time, and you create a 1-year synthetic instrument.
Okay.
You can trade individuals or you can trade them as a pack. The reds are the second four contracts out. So that is a 1 year forward if you trade them as a pack. The
Okay.
greens are the third year out, and it's the same thing. It's a 1 year pack or a 1 year period, 2 years forward. So it
Fair enough.
starts
Understood.
whites, reds, greens, blues, golds, and then goes another 5 years out. But for all
Okay.
practical purposes, it's really the first 5 years that trade pretty heavily. Um,
Okay.
so the sort of fulcrum of the curve has always been the fourth, fifth, and sixth contracts, kind of relating to the 2 year treasury. Those yields are very well correlated. Um,
Right.
when you go out a little bit, what I tend to watch is the reds to golds, the second year forward to the 5th year forward. And the idea there is that that sort of replicates twos tens. Um, And you can see on this chart, especially recently, it doesn't really replicate 530s, but it does, it does correlate fairly well to 2s, 10s. And for the ordinary trader, it's actually easier to just pick a contract in the reds, like the fifth contract, and trade it versus one of the blues or the first gold, which would be the 17th contract. And so you just do one contract to one contract. It's a little bit easier to manage than doing a ratio in the futures between twos and 30s.
That's right.
Where you also have to worry about what the cheapest to deliver is. Go ahead.
Right.
I'm sorry.
And the no problem. And the reason I just want to explain to people is that Eurodollars trade based upon yield. So it's actually, although it's a price, the way that it's calculated is it's 100 minus the yield of that contract.
100 minus the price of that contract is the yield. That's exactly right.
Yeah, I'm sorry. You're sorry. And so when you're trading a futures, you actually have to figure, like when you're trading a treasury kind of future, you actually have to figure out the proper ratio. And that's what you're saying is that you can do one for one. So if you wanted to say that like the second versus the fifth year like that yield spread was going to widen, it's much easier to do it in the Eurodollar market because basically you just pick two contracts and trade one for one, as opposed to if you wanted to do two fives or two tens, you have to figure out the proper ratio to make sure that you have the same. So that is something great to know. In terms of what do you think about the 5s, 30s, and do you think that this is it? I see in your chart that you noted that it never went negative.
It never went negative, but the thing is that what's particularly interesting right at this period, right now, is that the 530 spread has tended to steepen throughout this year, and when we had the employment data, it flattened quite a bit. The spread came in about 8 or 10 basis points, but then it immediately, with Powell's testimony, popped right back out. The inflation data was a little bit stronger, but you have Powell indicating, "Hey, we're gonna be easing." So it's really a classic setup for the curve to steepen quite a bit, and 530s is definitely leading the way here. I think it could get to 150 basis points pretty easily.
There we go. Music to my ears. Well, Alex, it's great. I really appreciate that. All that lesson and all that talk about Eurodollars.